Hi traders, Lance Beggs here from YourTradingCoach.com. I just thought I should shoot a video version of a recent article sent out to my email newsletter subscribers. So for all of you watching on YouTube but not subscribed via the website, this is some of the stuff you're missing out on from the email newsletter. In the previous article and now through this video, I aim to reveal the hidden secret of technical analysis. Did you know that there is a whole other world of technical analysis that most novice traders are either totally ignorant of or fear to go due to the fact that it might actually require some work? Well, there is, and I'd suggest that if most novices fear to go there, then perhaps it might be worth some investigation. So what is technical analysis? For most novice traders, it seems to be one of or a combination of the two following approaches. Firstly, the art of defining recent price action through classic charting techniques such as the Dow theory definitions of an uptrend or downtrend, or recognition of patterns such as channels, triangles, head and shoulders, cup and handles, or the double top showing on the screen right now. For others, technical analysis is the art of representing price action through the numerous indicators available on your charting platform, such as moving averages, stochastics, MACD, and so on. This is great, it's a good start, but the fact is that no matter how you define the structure of the market, whether based on Dow theory, Elliott wave theory, or through an indicator-based approach, it's important to remember that this structure defines past market movement. It's a simplification that allows you to quickly identify what happened in the past. Profits, though, come from future price action, not past price action. So having defined past price movement, these traders then use general rules associated with that past price action to justify an entry into the market. An example of a general rule used may be the break below the neckline in a head and shoulders pattern is a great entry short with a target equal to the distance from the neckline to the peak of the head. So for example, our trader identifies an uptrend with a left shoulder, a head and a right shoulder. They define the neckline here and enter short on the break of that neckline here for a target in around about that area here. Another example of simple rules used to get into the market. A moving average crossover is an indication of a change of trend. So identifying the EMA 10 crossing above the EMA 20, the novice trader enters long. Once again, this is good, hopefully at least better than random entry. The general rules for entry are fine. If you're satisfied they provide a slight edge, and if you have a complete understanding of the probabilistic nature of price movement and an appreciation for the necessity of position sizing and risk management, you may well make some profits. However, I'd suggest that there's a whole other world of technical analysis that you're not seeing that still won't guarantee success because the elusive holy grail doesn't exist, so stop looking, but it will provide further opportunity to increase your edge. Mastery of this hidden world of technical analysis will allow you opportunities to enter lower risk and higher probability trades. Lower risk trades through getting earlier entries closer to support and resistance areas so you can safely place tighter stops, and higher probability entries through analysis based more closely on the truth behind price movement rather than a general rule for pattern or indicator based entry. So where do we find this other world of technical analysis? Look behind your indicators or behind the classic charting patterns, and what do you find? Price action. It doesn't matter how you define past price action, an uptrend, a downtrend, a range-bound sideways trend, a head and shoulders pattern, an ascending triangle, wave 4 of a 5-wave pattern. It's just a label that describes an approximation of past market movement. The label is not important. What is important is the nature of price movement behind that pattern or indicator overlay. Too many people will say that because the price is below the 50-period moving average, or because the EMA 10 is below the EMA 20, or because they've identified a structure of lower highs and lower lows, the market is in a downtrend. They apply a label, downtrend, and that's it, end of story. No correspondence will be entered into. The market is in a downtrend and they're looking for trades in the short direction. Looking beyond the downtrend label to see how price is really moving can allow us to see the internal strength or weakness of the trend. It can provide you with an insight into the fear, doubt or greed of the market participants that create the price action, which then creates the price trend or pattern and moves the indicators. I'm not saying you necessarily have to get rid of your indicators. I use some myself. Just recognise them for what they are, a useful approximation of the market. And recognise that if you want to improve your edge, you may need to look behind the pattern, look behind the indicators, look beyond the label. and see what price is really doing. And ask yourself some questions. For example, is the volatility of price movement changing, and what does that mean for potential future price movement? See, for example, here a rapid expansion of volatility against the direction of the trend. What does that mean, and how could that impact future price movement? And see here a rapid expansion of volatility in the direction of the trend. What does that mean? How does that affect future price movement? How does that affect your position? How should you move your stops? Does that affect your target? Do you now move that? Is the momentum increasing here, or is momentum perhaps decreasing? And where is price now going from here, and why? Is the momentum of the current price move greater or less than the preceding swing, and what does that mean? So in this case, we're comparing this swing with the momentum in this swing here. And what does that mean for future price movement? In addition, is the momentum of the current price move greater or less than the previous swing in the same direction? And what does that mean? So this time we're comparing the momentum in this move with this move here, or possibly even the preceding one here. How is that momentum changing, and what does that mean for future price action? Let's go even deeper and consider the thought processes and psychology of the people who are long in this trade and currently sitting on a profit, perhaps entered way earlier down here at the beginning stages of the trend. Currently sitting on a great profit, where are these people looking to exit their trade? Where are they going to take profits? And where have they placed their stops? And what does that mean for future price action? Let's consider as well the psychology of the traders who are currently fighting this move, sitting in a drawdown, sweating on every tick and praying to the market gods, if you can just this once turn price around so I can get out at break even, I promise I'll never again take such a stupid trade. You might say, seriously, who is going short in this market? Well, if they got in here at the bottom, just as price broke this previous swing low, there will be traders going short, and they're currently sitting on a drawdown and sweating every tick of that market. Where are these people trying to get out at break even or at better price? And at what point up here will their fear become so great that they just have to get out? And when they do, what does that mean for future movement of the price? And what does that mean for your current position that may be on, either long or short, or for your potential to take a low risk, high probability trade? Let's consider as well the psychology of the people who are sitting on the sidelines having missed the whole move. Some of these will be professional traders. Where will they be looking to identify a low risk or high probability entry into the trend? Some of these will be novices. Where is the absolute worst place to enter, having chased the market and entered simply out of fear of missing out on the move? Yes, some people do enter right at the very worst tick possible. Where potentially is that, and what does that mean for future market movement? The answer to all these questions will make a great subject for future articles and videos, so there's more coming. For now, I'd just like you to start looking beyond the indicators and patterns and discover a whole other world of technical analysis, price action, and question how that will impact your trades. Examine the current internal nature of price movement, the speed, the momentum, and the volatility, and consider how this price action is likely to influence the decision making of the novice traders who will be entering and exiting the market based on their own fear or greed. Try to discover how you can use this information within your current strategy to lower the risk of entry, improve the probability of your entry being in the right place, and improve the management and exit of your position. If you're interested in improving your current edge in the market, analysis of price action may be just what you're missing, so check it out. I'm Lance Beggs from www.yourtradingcoach.com. Go to the website, check it out, and subscribe via the subscription boxes over here on the left hand side, just to be sure you receive all future articles and videos. And as always, be sure to use your stops. Happy trading.